Lesson 8. How to Invest Step by Step. Buying shares in a publicly listed company is what investing in stock implies. Those little portions are referred to as the firm's stock, and investing in it implies that you anticipate the company to grow and operate well over time. When this happens, your shares may become more valuable, and other investors may be willing to pay you more for them than you paid for them. That implies that if you decide to sell them, you may make a profit. 1. Make a decision on how you wish to invest in the stock market. There are various approaches to stock investment. Choose the way that better represents how you want to invest and how involved you like to be in choosing the shares in which you want to invest. 1. I'd want to choose my own stocks and mutual funds. Continue reading. This article breaks down what newbie investors need to know, such as how to choose the best account for your requirements and compare stock investments. 2. I'd prefer a professional to oversee the procedure for me. You could be a good fit for a robo-advisor, which is a business that provides low-cost financial management. Almost all major brokerage companies, as well as many independent advisors, provide these services, which invest your money for you based on your specific goals. 3. I'd want to begin contributing to my employer's 401k. This is one of the most common methods for novice investors to begin. It teaches rookie investors some of the most tried and true investing practices, such as making little monthly payments, focusing on the long term, and taking a hands-off approach. Most 401k plans enable you to invest in stock mutual funds, but not in individual equities. 2. Choose an investing account. Investing in stocks, in general, needs the usage of a brokerage account. For people who like to work with their hands, this usually includes creating a brokerage account. Opening a brokerage account. An online brokerage account is most likely the quickest and most cost-effective option to buy stocks, funds, and other products. You may start an individual retirement account, often known as an IRA, with a broker, or you can open a taxable brokerage account if you're already saving for retirement through an employer 401k or another plan. 3. Discover the distinction between investing in stocks and investing in funds. Taking the do-it-yourself route? Don't be concerned. Investing in stocks does not have to be tough. For the majority of individuals, stock market investing includes deciding between two types of investments. 1. Stock mutual funds or exchange-traded funds. Mutual funds allow you to acquire small quantities of several equities in a single transaction. Index funds and ETFs are types of mutual funds that track an index. For example, a Standard & Poor's 500 fund replicates the index by purchasing shares in the firms that make up the index. When you invest in a fund, you possess a little stake in each of these companies. Combining various funds allows you to create a varied portfolio. It's worth mentioning that stock mutual funds are also known as equity mutual funds. 2. Individual stocks. It is possible to build a diverse portfolio out of many shares, but it takes some effort and research. If you pursue this approach, keep in mind that individual stocks will have ups and downs. If you investigate a company and decide to invest in it, remember why you chose that firm in the first place, if you are nervous on a bad day. The benefit of stock mutual funds is that they are inherently diversified, which reduces your risk. A portfolio comprised mostly of mutual funds is the obvious choice for the great majority of investors, particularly those investing their retirement resources. 3. Mutual funds, on the other hand, are unlikely to rise as swiftly as some individual shares. Individual stocks have the benefit of paying off handsomely if you make a wise purchase, but the chances of any one stock making you rich are quite low. 4. Make a plan for your stock market investment. New investors usually have two queries at this stage of the process. How much money do I need to start investing in stocks? If you desire mutual funds but don't have a lot of money, an exchange-traded fund ETF could be your best alternative. Mutual funds sometimes have $1,000 or more minimums, while ETFs trade like stocks, which means you buy them for a share price, in some circumstances less than $100. How much money should I invest in stocks? Have we mentioned that investing in funds is the favorite approach of most financial advisors? If you have a long time horizon, you may allocate a significant portion of your portfolio to stock funds. A 30-year-old planning for retirement may have 80% of their portfolio in stock funds, with the remainder in bond funds. Individual stocks, on the other hand, are a very different story. As a general rule, limit them to a small portion of your investment portfolio. 5. Focus on investing for the long term. Stock market investing has shown to be one of the most effective strategies to accumulate long-term wealth. Over numerous decades, the average stock market return has been around 10% every year. However, bear in mind that this is merely an average of the whole market. Some years will be up and some years will be down, and individual equities returns may vary. The stock market is a fantastic investment for long-term investors, regardless of what occurs day to day or year to year. It's the long-term average that they want. Despite the fact that trading involves a variety of tactics and approaches, some of the most successful investors have done nothing more than adhering to stock market fundamentals. That often means relying on funds for the majority of your portfolio. Warren Buffett famously stated that a low-cost S&P 500 index fund is the greatest investment. Most individual stocks may only be chosen by Americans if they believe in the company's long-term growth prospects. The most difficult thing to do when you first start investing in stocks or mutual funds is to not look at them. Unless you want to defy the odds and thrive at day trading, you should avoid watching your stocks numerous times a day, every day. 6. Manage your stock portfolio. While obsessing over daily swings isn't good for your portfolio or your own health, there will be moments where you'll need to check up on your stocks or other investments. If you use the techniques outlined above to acquire mutual funds and individual stocks over time, you should review your portfolio at least once a year to ensure it is still in accordance with your investing objectives. Here are a few things to think about. If you're nearing retirement, you might want to shift some of your stock holdings to a more safe, fixed-income assets. If your portfolio is overly concentrated in one area or industry, consider purchasing stocks or funds from a different sector to increase diversity. Finally, consider geographical diversification. Vanguard advises that international stocks account for up to 40% of your portfolio. You may gain this exposure by investing in foreign stock mutual funds.